How to survive the fluctuated stock market. Warren Buffett, Benjamin Graham, and Peter Lynch are all well-known investors who have had significant impact on the field of investing. Some common investment strategies that they have used include value investing. Warren Buffett is known for his value investing approach, which involves identifying undervalued companies with strong financials and a durable competitive advantage. Benjamin Graham is also known as the father of value investing, and his investment philosophy has had a significant influence on Warren Buffett and other value investors. Value investors look for companies that are trading at a discount to their intrinsic value, and they emphasize the importance of fundamental analysis and careful security selection in investing. Growth investing. Peter Lynch is known for his growth investing approach, which involves identifying companies that are expected to grow at an above-average rate. Growth investors look for companies with strong earnings and sales growth, and they are willing to pay a premium for these companies. Long-term perspective. All three of these investors have a long-term perspective when it comes to investing. They believe in holding on to good investments for the long term and riding out market fluctuations in order to potentially generate stronger returns over time. Thorough research and due diligence. All three investors also emphasize the importance of thorough research and due diligence in investing. They believe that it is important to understand a company's business and its financials in order to make informed investment decisions. As a way to follow the strategies of those three investors, we can consider a passive investment as an option in a fluctuated market. Passive investments are investment vehicles that are designed to track the performance of a particular market index or benchmark, rather than attempting to outperform it. Passive investments generally have lower fees than actively managed investments, as they do not require the investment manager to constantly buy and sell securities in an attempt to outperform the market. Some examples of passive investments include index funds and exchange-traded funds, ETFs. Index funds are mutual funds that are designed to track the performance of a particular market index, such as the S&P 500. These funds typically have a portfolio that is composed of the same securities as the underlying index, and they are managed in a way that seeks to closely match the performance of the index. Exchange-traded funds, ETFs, are investment vehicles that are listed on an exchange and can be bought and sold like stocks. Like index funds, ETFs are designed to track the performance of a particular market index or benchmark. ETFs typically have lower fees than actively managed mutual funds, as they are passively managed and do not require the constant buying and selling of securities. Overall, passive investments can be a good choice for investors who are looking for a low-cost way to diversify their portfolio and track the performance of a particular market or sector. There are several ways to invest in the S&P 500 and NASDAQ 100. Index funds. One option is to invest in index funds that track the performance of the S&P 500 or NASDAQ 100. These funds typically have a portfolio that is composed of the same securities as the underlying index, and they are managed in a way that seeks to closely match the performance of the index. Index funds are available through brokerage firms and financial advisors, and they can be purchased through a taxable or tax-advantaged account, such as an individual retirement account, IRA. Exchange-traded funds, ETFs. Another option is to invest in exchange-traded funds, ETFs, that track the performance of the S&P 500 or NASDAQ 100. ETFs are listed on an exchange and can be bought and sold like stocks. They typically have lower fees than actively managed mutual funds, as they are passively managed and do not require the constant buying and selling of securities. ETFs can be purchased through a brokerage account. Individual stocks. You can also invest in the S&P 500 or NASDAQ 100 by purchasing individual stocks that are included in these indexes. This approach allows you to have more control over your portfolio, but it also carries more risk, as the performance of individual stocks can be more volatile than that of the overall market. Before investing in any financial product, it is important to carefully consider your investment goals, risk tolerance, and financial situation. It may be a good idea to consult with a financial advisor or professional to determine the best investment strategy for you.